Please welcome to the stage Managing Director at GIZ, Ingrid-Gabriela Hoven, Director of the Research Department at the International Labor Organization, Richard Samans, and Director of Development, Finance, and Distribution at JP Morgan, Jiten Wignarajah, for a conversation on pathways to a just transition.
That initial conversation, I think, set the stage very well for us to now dive even further into details. I'm really excited to have the diversity of perspectives on this panel as well, from all of you coming from GIZ, JP Morgan, and the ILO. And thinking about what was just said, and also the work that you're all doing. Ingrid, first I'd like to turn to you, and in your work at GIZ, but also your history as being part of and within international financial institutions. When you think about your work in GIZ and the work around the world, how are you characterizing and thinking about a just transition? And then how is that informing the work that you're doing?
Yeah, thank you so much, Allison, for having me. And I have to admit that this is not an easy act to follow, quite frankly, because I'm very thankful to the Minister of Tuvalu and Mark Mallow-Brown really to bringing the urgency into the room. Because as has been said, sometimes we get a bit caught into technical approaches and big numbers, but I think really to realize that the climate impact that many countries are facing on a daily matter is really about the individual survival and the livelihoods for many communities. And Tuvalu is just one example in this respect, but a very important one. And I also would like to recognize the leadership that Tuvalu has played for many years in many conferences of the parties. And without Tuvalu, actually, we haven't recognized at all in the Paris Accord that 1.5 degrees has to be the benchmark, not 2 degrees. So many thanks. Just transition. GIZ is an implementing agency. We are working on the ground with partner governments. We are working with civil society, with the private sector. So what does just transition mean for us? What is our concept? That means that when we embark on a medium and long-term structural change toward net zero, so the decarbonization of societies, consumption, production, and economies, that this has to be done in a way that it remains socially just and fair for the people that are going to undergo this transition. Of course, this is easier said than done, and we experience this actually also in our home country, in Germany, how difficult it is to balance out different interests and to make sure that when you go embark on the transition, that you really take care of those people that at least for a moment, for some period, may actually not consider themselves as the winner of such a transition. I think in global term, and Nick Stern again yesterday told this story, there is no other growth story for us than decarbonizing the economy. There is no other pathway because it would be much more costly for us to stick to a fossil fuel economy. So this is the way that we have the route that we have to undergo. But let me give you an example. We are working with the South African government in a multi-stakeholder and multi-government, multi-institutional environment. The World Bank is joining this endeavor, the UK, the Agence Française de Développement, so many bilateral and multilateral donors, really to give South Africa a hand to get out of fossil fuel. And this is huge. More than 130,000 people are directly working in the coal mines. Indirect and induced jobs account for another 3,000 people. So this is huge. So how do we undertake the transition? According to the labor analysis that we undertook together with the South African government, more or less 50% of the jobs in the coal mines are going to be lost. But the good part of the story is that when you look what kind of opportunities lie ahead for South Africa in greening the economy, they are going to create 8,000 more jobs. But the point is, of course, not all happens in the same region, and it won't be easy especially for those that don't have a higher skill, really, to get upskilled or reskilled so that they see income opportunities within the new and emerging sectors that will be created through a green economy, windmills, renewable energy, and so forth. So one has to invest at the same time when one embarks in really getting out of coal. It's not simply about transforming the energy sector. It's much more about really generating the right pathways so that those people that are going to be affected immediately still have a livelihoods. For some, this may be entering into self-employment, training programs, be reskilled. But for other ones, this may perhaps not be feasible. What about labor migration? In those cases, I think we also have to consider to strengthen social safety nets, social security systems, so that you can provide like an intermediate cushion until actually the new economic opportunities are there or emerge and can be actually taken advantage of those people that may be affected through the transition. At the end, I think it's important, there is no one-size-fits-all approach. You have to build consensus internally. Consensus means that people have to come to the table, civil society, the private sector. According to our experience, if you are open-minded to give the space for dialogue, criticism may emerge pretty soon. You need to forge consensus, try to build up a good narrative, to really to show that there are actually at the horizon there are like big opportunities if you go along the route to decarbonize your economy.
How are you thinking about this in terms of that transformation and what is really needed to transition, upskill, and reskill new workers to be ready for this transition?
Thanks very much for the question and for the invitation to be here. Maybe just a couple of statistics just to set the context here. We did some work a few years ago about the likely labor market effects of this transition to within 2-degree world. This was before the 1.5 number became fixed as really the preeminent goal for the international community. We found in running the projections that there would actually be a net increase of about 18 million jobs worldwide, about 24 million created gross and 6 lost, and that of 163 sectors or so, only 14 will, according to these projections, suffer employment losses of more than 10,000. Obviously, the job losses will be concentrated in fossil fuel-related industries, but there is real potential here. But as our colleague from GIZ said, it isn't a clinical antiseptic process. It really involves serious change in people's lives. And therefore, societies and governments within them have a certain responsibility, if they adhere to the principle of social justice, not to leave those people by the wayside. So that's an element of social justice. One other stat, just to give you a sense of what this means to people on the ground, is the rising temperatures and heat stress. We've done some estimations there as well and have estimated that by 2030, on a global basis, global average, over 2% of working hours will be lost because of the heat. And that translates into about 80 million full-time equivalent jobs, or about 1.4% of GDP globally. Now, obviously, there are big differences in different regions and different sectors, depending on how much you work outside, et cetera. But I just wanted to give you those two elements to put this a little bit more into context on the ground. Now, there are two dimensions here of just transition that I think are worth thinking about and talking about in policy terms. One is the in-country dimension, which we just heard a really nice exposition of, the various cross-currents that are going to fit people, and the kinds of policy interventions, support, that can help facilitate a just transition. And I'll have one thing to say about the policy innovations that are required in this regard, and that is that if we're to really take this seriously, that you need a socially just facilitated transition in order to be able to succeed environmentally, economically, morally, et cetera, then we need actually, when we make, and we're here at the heart of the international financial architecture, the annual meetings of the fund and the bank, we need to connect the dots here. We need to walk and chew gum at the same time, in the sense that as we're making loans or grants to facilitate this industrial and energy system transformation, part of that should be a stream that goes to fund the necessary analytics and policy support for countries in terms of labor market transitions, training, social protection system, identification of gaps, the support for countries to be able to fill them, employment services, and the like. That's not happening yet. We have a conceptual alignment on the need for a just transition, but that has not yet been translated in operational terms into what it means for the business of development cooperation, and even inside governments. The other dimension is, of course, the global dimension of just transition. We heard that in a very, very stirring way at the first panel here, is that there's a global equity issue, a burden sharing issue. And that comes down to, in many respects, also relevant to the discussions here today in this town, the volume of support in this regard. And maybe I'll come to that in a second round.
Thank you very much for that. All incredibly important points. And, you know, I appreciate what you said about needing more data and the analytics to really understand what does this look like, what and where is the investment needed most, and how can that be most effectively deployed for impact. On the question of impact and also mobilization of capital, Jiten, I'd like to turn to you. You know, on this panel and in the previous conversation, it's certainly been noted and a broad recognition of the need to mobilize more capital, including from the private sector. You know, in your role as the Director of Development for Finance and Distribution, I'm curious how you're thinking about this and what's needed to leverage the capital markets and what's needed to attract more private sector investment.
Sure, and thanks for the opportunity to speak. I'd like to talk about three topics. One, underlining the importance of the capital markets in terms of getting size into these transition opportunities. The second is how impact disclosure can be helpful, particularly for EM issuers. And the third is to explain why standardization of impact is needed to drive scale. So maybe to start with the bond market, and this echoes something that was mentioned in the last panel. There's a lot of institutional investment that's out there. The Global Sustainable Investment Alliance estimates that at 32 trillion, which is obviously a significant amount, but there's frustration as to the funds not flowing, as mentioned before. And if you look at bonds, which is the biggest constituent, bonds, equity, and loan, there are established labels, so the ESG labels, the green, the social, sustainability bonds. They've had a record year, but those are global issuances. If you focus in on emerging markets, it's a little bit of a tougher story. So we have to recognize that investors have been risk off for a number of years on the back of conflicts, high inflation, high interest rates, and even the most recent tragic events are something that's come up already in the conversations. So EM investors have had a slightly unconstructive environment when it comes to looking at these opportunities. And then if you look at the instrument that was created specifically for transition, so transition bonds, they've struggled in uptake because, one, the requirements for issuers are fairly rigorous, so there's a real focus on science-based targets, quite rightly. But also investors, institutional investors, these are insurance companies, pension funds, asset managers, they treat those bonds with a little bit of skepticism. They sometimes feel that these are fossil fuel companies that are trying to access ESG capital by embellishing their credentials. So I think, not to be too pessimistic, but more needs to be done, potentially at the entity level as opposed to just at the instrument level. So that brings me on to the second thing, which is impact disclosure, which feeds off some of the other comments, which is, in our work, it's been very difficult for our clients in emerging markets, so these are sovereigns and corporates, to sometimes get good ESG ratings or to disclose the information that institutional investors need for their regulatory compliance. So these are things like the European Sustainable Finance Disclosure Regulation. It's hard for them to produce that data. And the reason why is, in my opinion, that these standards and the regulators have often looked at baselining this against a developed market issuer, which is not the easiest when you translate it to an EM context. But when we speak to our investors, the institutional investors, they really care about impact as a dimension to try and channel more capital in. And they understand that it's not necessarily your score at this point in time, but what are you doing to change? Like, what is your impact on the community or on your local environment? So I feel that impact will become more and more of a relevant consideration within ESG. And if you look at the stats from the Global Impact Investor Network, there's already 1.2 trillion of that 32 trillion I mentioned earlier, which is focused on impact as a lens. And so the last thing I'll say on this is, in terms of scaling, we need standardization with impact. There's a lot of good initiatives that are out there, things like the ASCO initiative for sovereigns, but you need harmonization for people to invest with confidence in impact-labeled instruments. We're actually working on a task force with other standard setters, underwriters, rating agencies, institutional investors, and DFIs and MDBs, because they're the sort of experts in this field. And that's meant to achieve three things. One, to produce guidelines for entities to report their positive and their negative impacts. I think it's very important that net impact is considered. The second is to find a platform, a repository of information for investors so that they can look up disclosure of targets and progress in an easy fashion. And the third, and I think this is the most important part, is verification. So just as we had greenwashing, you don't want impact washing. And channeling this extra capital, especially when transition, I think there's a big theme of your impact on jobs and so forth. The last thing you want is things that are oversold. So verification, validation, that part is the, I think, most essential limb in order to make sure that these transition stories are credible.
Thank you for that. And I'd like to connect the dots on impact and turn both back to you, Ingrid, and to Richard, to you. You know, Ingrid, you're working with governments and organizations and countries around the world on very specific projects. And I'm wondering how you and GIZ are thinking about impact, tracking, verification, accountability as you're working with, you know, very directly with different stakeholders on the ground and the need to track and report that, and also understanding, as you articulated earlier, the challenges on the ground as well. How are you thinking about that?
Well, of course, in the whole international cooperation business, I think we are one of the sectors that has been more heavily evaluated than any other one with monitoring and tracking systems, because to a great extent, we spend taxpayers' money, so the scrutiny is high. It's getting higher, actually, as resources get scarce. And so, actually, we are looking at the impact through the lens of the partner government, quite frankly, because they are the ones that are most interested in really to see that there is a change on the ground, that the livelihoods get better. So we do this project by project at the macro level, in accordance with the metrics and the criteria that we agreed upon with governments. I mean, those that commission the programs and finance them, and of course, the countries, the recipients that actually have, by their own doing, actually make the programs a success. But let me perhaps, so this is really done, and also in those cases where we actually try to embark on a just transition. There are metrics in place with respect to CO2 reductions year by year, but also we do actually baseline studies in order to get a better sense what is happening in social terms on the ground. And I would like to add a dimension that I forgot in my first intervention. We also have to look into the gender dimension of just transition, often overseen. But of course, women are differently impacted by transition strategies or by opportunities. And especially if we consider that the transition should be equally just to women and men, we have to make sure that in all the employment generation, skilling, training programs, self-employment programs, the new labor policies, that the gender dimension is not being overseen. If you allow me, Allison, I would like perhaps briefly react to a point about the mobilization of resources. I would certainly like to echo those that have said, of course we have to come from billions to trillions, and the opportunities are huge, as you've just explained. But we have seen in the past, and this is also equally confirmed by the MDBs and their chief economist, we need a higher level of concessional funding. In IDA, in loss and damage, in the Green Climate Fund, and so far actually in order really to bring the private sector in order really to reduce the risk perception. Unless the international community is not willing really to commensurate their actually contributions to the challenges that we are facing, also the other instruments will fall short. Because in most cases, and I work together with insurance companies, with the private sector, they always want some kind of concessional contributions, either to lower risks or to prepare the markets. We are working since a couple of years with insurance companies, and what we are doing, GIZ and UNDP alike, is actually working together with governments in order to shape the right regulations, to shape the markets so that then the private insurance companies can come in. And additionally, to make insurance products affordable for those people that are most in need. And this requires a concessional element. Of course, in industrial countries, most of this is being done by taxpayers' money, by taxation. And therefore, another element that we have to embark on more forcefully is actually domestic resource mobilization in many countries of the global south. So there has to be a match of different sources of funding really to make it happen.
Thank you for that. And in terms of matching funding, I'm going to go back to a comment you made previously, Richard, about ensuring that that capital which is mobilized and allocated is also going to support workforce transition, upskilling, and training. And so you had mentioned or started to go down the path of what you'd like to see this week and what some of the mechanisms are that could potentially change and that need to be front of mind in the meetings this week to ensure that that happens.
So let me give you a couple of things specifically. One, on the point I was making earlier about connecting the competencies in the multilateral system better, the ILO has not a tremendous amount, but more capacity to do this kind of labor market and social protection system estimation, assessment, and policy support than any other. The MDBs have social departments, but they're limited in capacity, but they're the ones making the restructuring loans. Our Secretary General of the United Nations talks about networked multilateralism as a key to the future of global cooperation. This is one such example in the just transition area where we need a better networking of the competencies in different parts of the multilateral system in the service of the individual countries on the ground. But now let me turn to the impact question and come at it from not a project level, but from a global level. You can think about the IPCC scientists' advice, and that has been taken up by governments and agreed on the 1.5 and the well below 2% numbers as our ultimate impact metric, right? That's an outcome indicator that people are looking to see. That will require, as you have just said and Mark said earlier, a different role for the state, for the official sector in this area. The market is not going to mobilize in the absence of significant incentives to do so, whether it be grant, first loss guarantee, co-financing, you name it. There are various instruments. One of my hats that I wear is I'm the organization's have been its G20 Sherpa and its finance deputy. So right after this, the G20 finance ministers are having a working dinner where they're going to be discussing a very significant report that was created by the Indian G20 presidency that is releasing its second volume this week. And basically, the bottom line for you is that it is suggesting that there needs to be about a $200 billion per year increase in MDB resource mobilization. That's about 10x, 10 times what's in the pipeline right now of very good reforms that were agreed that took a long time to agree, but that's 10x above what is in the pipeline right now. Now, there are proposals in there that are very, very good ones. I think we've got a colleague here, Avinash Persaud, who's inspired some of this as well. He may talk about this later. But there is a significant further distance to be traveled if we're going to hit the global impact metric that's been set for us in this regard. And that will take not just network multilateralism, but it will take more creative. I myself have a series of proposals coming out in a book that will be released late next month, which would travel the remaining distance. Suffice it to say that within the existing capabilities and resources of the international financial institutions, the fund and the MDBs, there is sufficient resources there without affecting AAA ratings to produce a $2 trillion increase over 7 years from now until 2030, which would amount to about a 3% increase, at 3% of GDP equivalent of increased external flows to countries. That's just within, by better utilization of the existing capabilities. That would require a better networked operation between the two of them. It has to include SDRs. The one point I'll leave with you on this point, for those of you who follow the sort of arcane world of special drawing rights, is that the limiting factor, which we were getting to work around with something called hybrid capital, is a requirement that it be considered a central bank reserve asset, even if it's on lent to a developing country. That is not a technical constraint. It is a political constraint. SDRs are fiat money, just like when a government that borrows in its own currency decides to issue new currency to basically increase liquidity in the market. It's a political decision, basically. But the IMF, with all of its good work recently, and I'll end here, of setting up a trust to funnel some of these rechanneled SDRs in, is not a development institutions. It's not really in the business. It doesn't have the capacity, the capabilities to be making development cooperation and climate restructuring loans. It's basically a facility to help countries with balance of payments crisis problems. There should be a much better networked way where the SDRs are created by the IMF, which is a monetary authority that creates liquidity, and then there's a wholesale funding arrangement to the actual operating agencies of the MDBs, who are accredited facilities, to scale that on the ground, network among them to do it better and manage the risk. That's the level of ambition that's going to be required to get the impact that the international community has identified it wants at the global level. Thanks.
Thank you for those numbers. Certainly the scale is daunting, but it's certainly encouraging and hopeful that, as you say, it's possible. And with greater efficiencies and networking, that can be mobilized. You know, certainly within the MDB system, but I'm curious, I saw you nodding, Jiten, and to close us out as we run up on time, I'm curious, from your perspective, then what are you thinking as you're reacting to Richard's comments about those efficiencies, and how also can the private sector be part of that process?
Sure, and I see I've got 50 seconds, so I'll keep this quick. But I think moving from an originate to hold to an originate to distribute model is key for the MDBs. I think with Ajay coming in at the World Bank Group, we've already seen this idea of just sort of making things more efficient and quick. I think we also need to focus on really the big emitters. I think sometimes we hold small emitting countries to a very high standard, and we sort of paint everyone with the same brush. And I think there are some initiatives, and I think of the Global Infrastructure Facility, for example, which are good, and they just need more money, more funding from donor countries. Because for us, the real need in transition is a supply of bankable projects. At the moment, that's the bit where the MDBs can help the most. And just to finish with the comments on developing local markets and FX and so forth, those are critical. I think local currency, especially for infrastructure projects, is vital.
Thank you for that, and all being very concrete in your contributions and your ideas. They're incredibly meaningful, and we're all learning from them, so thank you again for being here.